Imagine you just added the equivalent of an entire mid-sized city to your customer base in a single year. Your profits spiked nearly 15%, your infrastructure is just humming along, and you're operating in the most economically vibrant state in the country.
Right. Sounds like a dream scenario.
Exactly. And yet, despite all of that, Wall Street is telling you to brace for a slowdown. So welcome to this Talk Tickers edition of our deep dive. Today, we are taking the jargon-heavy Q3 2026 earnings call from Atmos Energy Corporation, that's ticker symbol ATO, and we're putting it under a microscope.
Which is, an exercise we don't usually apply to the utility sector. I mean, when investors think of utilities, they typically think of slow, plodding dividend payers. Boring, right?
Very boring. Sleep at night stocks.
Exactly. But looking at the numbers Atmos just posted for the first 9 months of their fiscal year, there is a really complex, almost hidden narrative here. It's about the physical realities of the American energy grid, regulatory windfalls, and, the friction that comes with hypergrowth.
Yeah, and our mission today is straightforward. We are cutting through all that corporate speak to see if this natural gas utility actually deserves a spot in your portfolio. And for some context for you listening, Atmos Energy is a sprawling natural gas distributor heavily centered in Texas.
All right, heavily centered there, yeah.
Right, and we are looking specifically at their performance leading up to the summer of 2026. The vibe today is data forward, opinionated, and highly actionable. We want the numbers, we want the mechanics behind those numbers, and most importantly, the bottom line for your capital. Let's just jump right in.
Let's do it.
So the traditional appeal of a utility stock is that it functions like a shock absorber for your portfolio, right?
Yep.
You trade explosive tech-level growth for capital preservation and a reliable yield.
Right. It's a defensive play.
Yeah.
Buy a gas or electric utility so you can sleep soundly during recession. The thesis there is that, no matter what the broader economy is doing, people still need to heat their homes. They need to cook their food, run their factories.
The revenue stream is theoretically insulated from consumer discretionary spending.
Exactly. It's not like buying a new TV. You have to pay the gas bill.
Right. But then you look at the top line numbers Atmos just reported for the first 9 months of 2026, and that whole sleepy utility narrative just completely goes out the window.
Very good.
I mean, they brought in a year-to-date net income of $1.2 billion. And when you translate that into earnings per share, which is, the metric Wall Street tracks obsessively, it comes out to $7.33 per diluted share.
Which is just a remarkably robust figure for a company in this specific sector.
It is, but the context of that figure is what caught my eye immediately. That 733, it represents a 14.5% increase over the prior year period.
Yeah, that's a big jump.
A 14.5% earnings jump is a suspiciously fast tempo for a company whose primary business involves, digging trenches and laying steel pipes.
Right. They aren't a software company.
Exactly. If a software as a service company posts 15% growth, you nod your head. When a regulated natural gas distributor does it, it raises some serious eyebrows. My initial thought reading the transcript was, are they suddenly selling gas at a massive premium, or is there a catch hidden in the accounting?
And it is absolutely the right question to ask. To find the answer, we actually have to unpack a significant piece of Texas regulatory history. Management leaned on this heavily during the call.
Okay, lay it on me.
So the short answer to your question is that the numbers are real, but that 14.5% growth rate is heavily synthesized. It was artificially boosted by a legislative mechanism, specifically Texas House Bill 4384.
Okay, yeah. I saw CFO Chris Forsyth mention that bill. He pointed out that $132 million of that net income came directly from its impact. But the call completely glossed over what the bill actually does.
They usually do.
Right. So what is House Bill 4384, and how does a piece of state legislation suddenly drop $132 million to the bottom line of a private company?
To understand the mechanics of that bill, you have to look backward at the volatility of the Texas energy grid over the last few years, particularly the fallout from extreme weather events like Winter Storm Uri.
Oh, right, the big freeze.
Exactly. During those severe freezes, the demand for natural gas skyrockets to keep homes warm and power plants running. At the exact same time, wellheads out in the production fields can freeze up, which restricts supply.
Basic economics there. Demand goes through the roof, supply drops, and the wholesale price of natural gas absolutely explodes.
It doesn't just explode, it breaks the scale. Utilities like Atmos are legally obligated to procure that gas to keep their customers alive.
Yeah.
Even if the spot price is 100 times the normal rate.
Wow.
Yeah, so they incur billions of dollars in extraordinary costs in a matter of days. Now, under normal circumstances, a utility passes the cost of gas directly onto the consumer. But you can't send a residential homeowner a $10,000 gas bill for a single week of heating.
Right, that would cause mass defaults and political chaos.
Absolutely. So the utility is left holding this enormous bag of debt.
This seems like a fast track to bankruptcy for them, honestly.
Which is exactly where the state legislature steps in with this concept of securitization. House Bill 4384 is a mechanism that allows gas utilities to take those extraordinary state-mandated costs and securitize them.
Okay, wait, break that down for me.
Sure. The state essentially facilitates the issuance of bonds to pay off that immediate crushing debt.
Okay, let me make sure I'm translating this correctly for you listening. The utility takes that huge lump sum of emergency debt, and instead of trying to collect it all at once from the customers, they spread it out.
Right.
They issue bonds, and then they add a tiny, almost unnoticeable surcharge to every customer's monthly bill over the next, say, 20 or 30 years to slowly pay back those bondholders. Is that right?
That is the structural reality of the solution, yes. But the earnings boost the part Wall Street cares about comes from how that debt is treated by regulators. Through this legislative process, the utility gets to establish a new, higher baseline for their rate base.
Oh, interesting.
Yeah, they are permitted to earn a regulated return on these structured assets. Forsyth explicitly noted how this windfall was divided. He said 71 million of it was recognized in their local distribution segment, and the remaining 61 million was recognized in APT.
And APT is Atmos Pipeline Texas, right? Their massive intrastate pipeline network.
You got it.
So when we strip away all the jargon, 63 cents of that $7.33 earnings per share came exclusively from the implementation of this legislation.
Yes, exactly.
It's basically a permanent structural adjustment to their balance sheet, and it's subsidized by the regulatory environment.
That's right. And as an investor, you really have to treat that 63 cents with extreme caution. As one of the analysts on the call, Luke Finker, pointed out during the Q&A, this is a discrete earnings benefit.
Meaning it's a one-and-done thing.
Right. It establishes a new floor, but it is not a recurring growth engine.
It's comparable to getting a structural readjustment to your salary, I guess. Let's say your company does a market analysis and realizes you are underpaid, so they bump your base salary up by 15%.
Which is great news.
Fantastic news, right? You are permanently making more money, your baseline has shifted. But if you start budgeting your life, assuming you are going to get another 15% structural adjustment every single year, you are going to go bankrupt very quickly.
That is a highly accurate way to frame it. And honestly, management themselves confirmed this limitation on the call. They referred to fiscal 2026 as a, quote, step year change.
A step year change, okay.
Yeah, and looking ahead, they explicitly stated that earnings per share growth will moderate back down to their historical target range of 6 to 8%.
Which, to be fair, is still an incredibly solid trajectory for a utility company.
Absolutely.
But if a retail investor buys Atmos stock today because they just saw a headline about 14% growth and they think they're buying a momentum stock, they're fundamentally misunderstanding the data.
They are buying yesterday's regulatory victory. That's the danger.
Okay, so we know the legislative magic trick artificially inflated the top line. But a company cannot survive on regulatory step-ups alone, right? They have to actually operate a business.
Right, they have to lay pipe and sell gas.
Let's pivot to the story behind the numbers, the organic business drivers. What is actually moving the needle on the ground for Atmos right now?
The fiscal growth metrics are arguably the most compelling aspect of this entire earnings call because they point to durable, multi-decade demographic trends. Over the last 12 months leading up to June 30th, Atmos added nearly 51,000 new customers to their system.
I just want to ground that number in physical reality for a second. Adding 51,000 customers isn't like a streaming service, adding 51,000 subscribers where you just, provision some extra server space and send a welcome email.
No, not at all.
51,000 utility customers is essentially wiring up a brand new mid-sized American city from scratch every single year.
The logistics are just immense. I mean, you have to secure rights of way, you have to hire union labor, operate heavy trenching equipment, lay miles of local distribution mains, and then you have to run individual service lines to every single property, install the meters, test the pressure.
It's a massive undertaking, and the source material highlights that nearly 39,000 of those 51,000 new customers were located right there in Texas.
Right.
This speaks directly to the macroeconomic boom happening in that state, which CEO Kevin Akers spent a considerable amount of time highlighting in his prepared remarks.
He did. He cited data from the Texas Workforce Commission, pointing out that the state continues to add jobs at a rate far outpacing the national average. But the quality of those jobs is what matters most for a utility.
Right. What kind of jobs are we talking about?
Akers specifically highlighted that in 2026, Texas added 3 new Fortune 500 companies to its roster, bringing the state's total to 57.
He noted that's the most in the nation, right?
Yeah.
And the highest concentration in Texas since 2010. And this is the downstream effect of corporate migration that investors often miss. When a massive corporation relocates its headquarters from California or New York to the Dallas-Fort Worth Metroplex, they bring thousands of high-paying white-collar jobs.
Yes, they do.
Those employees immediately enter the housing market. They buy new builds in the suburbs, and those homes need heating, they need hot water, they need gas ranges.
And Atmos is positioned as the default toll collector for this entire demographic shift. They don't have to guess which tech company is going to win the AI race or which manufacturer will dominate their sector.
Right. It doesn't matter who wins.
Regardless of who wins the corporate wars, if they set up shop in Texas, their employees need energy infrastructure. Atmos is quite literally laying the groundwork for that migration.
But here's where I want to push back and challenge the narrative a bit, because growth sounds phenomenal on a quarterly earnings call. Adding 51,000 customers is a great headline. But as we just discussed, trenching through suburban Texas and laying steel pipe is incredibly capital intensive.
Oh, highly capital intensive.
Steel is expensive, specialized labor is expensive, navigating local zoning is a massive headache. So how is Atmos actually turning these new, very expensive rooftops into higher net profits? Because in the utility world, if the cost to acquire and connect a customer outpaces the regulated revenue that customer brings in, well, growth can actually destroy shareholder value.
You've isolated the exact core tension of the regulated monopoly model right there. Growth requires upfront capital, and that capital must be authorized to see a return. The mechanism they use to turn those new trenches into profits is the rate case. And they leaned heavily into this during the call.
Let's look at the numbers they provided on that. CFO Chris Forsyth stated they successfully implemented $227 million in rate increases across both of their operating segments.
Right.
Furthermore, since the beginning of the fiscal year, they have secured $396 million in annualized operating income increases.
That is just a staggering demonstration of pricing power. And it proves that they maintain a highly constructive, very functional relationship with their regulators.
Let's pause and explain the mechanics of a rate case for you listening, because it's completely foreign to how normal businesses operate. If a restaurant's food costs go up, they just, reprint the menu with higher prices.
Right, they just update the chalkboard.
But a utility cannot do that.
No, they cannot. A utility operates as a monopoly in its service territory. So to protect consumers from price gouging, the state imposes very strict oversight. If Atmos wants to raise the base rate on your monthly bill to cover the cost of all those new pipes they're laying for the Fortune 500 employees, they have to file a formal rate case with the Public Utility Commission.
Which is essentially a massive bureaucratic trial.
It really is.
They have to open their books, prove that every single dollar they spent was prudent and necessary for the reliability of the system, and then essentially beg the commissioners for permission to pass those costs onto the ratepayer, along with a predetermined profit margin.
And consumer advocacy groups will fight them every step of the way, arguing that the investments were wasteful or unnecessary. So the fact that Atmos successfully navigated this gauntlet to the tune of nearly $400 million in annualized increases is a major signal to investors.
It's huge.
It shows that the regulators fundamentally agree that the capital Atmos is deploying to support the Texas population boom is necessary, efficient, and legally entitled to a return.
And they are keeping their foot on the gas. The call noted they currently have 7 filings in progress, seeking another $334 million in annualized increases, which they expect to hit in the first quarter of fiscal 27.
It's a continuous cyclical engine. You invest capital, you file for recovery, raise the revenue baseline, and repeat.
That cycle is the heartbeat of utility investing. Okay, so that covers how they squeeze profit out of the residential sprawl. But I want to pivot to a different data point tucked into the commercial and industrial metrics, because honestly, this statistic completely blew my mind and changed how I view their growth strategy.
Let's look at it. What jumped out at you?
During the third quarter, they added 600 commercial customers, bringing the year-to-date total to 2,500. But the industrial side is the real story here. They added 5 new industrial customers in Q3 and a total of 12 new industrial customers for the entire fiscal year.
Now, on the surface, 12 industrial customers seems statistically irrelevant compared to the 51,000 residential customers we just discussed.
That was my initial thought, too. 12 customers sounds like a rounding error. But then CEO Kevin Akers dropped a volumetric translation. He said those 12 new industrial facilities are anticipated to consume approximately 950,000 MCF per year once they're fully operational.
Right.
And he noted that is volumetrically equivalent to adding 18,000 residential customers.
It's a phenomenal metric. It perfectly illustrates the hidden leverage in their business. And just for the listener, MCF stands for 1,000 cubic feet of natural gas. It is the standard unit of volume in this industry.
So 12 factories or processing plants are going to draw nearly 1 billion cubic feet of gas annually. That is the exact same energy demand as 18,000 individual homes.
If you are an infrastructure investor, industrial load is the holy grail. The economics of serving a factory versus serving a residential neighborhood are just night and day.
Walk me through those unit economics. Why is an industrial user so much more lucrative for Atmos?
It comes down to 2 things: the demand profile and capital efficiency. Think about how a residential customer uses natural gas. It is highly seasonal and very weather dependent. A homeowner runs their furnace on blast during a cold snap in January, causing a massive spike in demand on the system.
Right.
But by July, the furnace is off, and they're only using a trickle of gas to heat water for showers or, run a stove. This creates extreme seasonal volatility for the utility. They have to build infrastructure capable of handling the massive January spike, even though those pipes sit mostly empty in July.
It's terribly inefficient. It's like you build a 10-lane highway just for rush hour traffic, and the rest of the day it's a ghost town.
Precisely. Now compare that to an industrial customer. A chemical refinery, a large-scale manufacturer, or a food processing plant isn't using gas to keep people warm. They're using it as a fundamental input for their industrial processes.
Ah, I see.
So they require a massive, consistent baseload of energy 24 hours a day, 7 days a week, 365 days a year, regardless of whether it's snowing or 100 degrees outside.
Highly predictable, flatline revenue.
Exactly. Add to that the infrastructure to volume ratio. To capture the volume of 18,000 residential homes, you have to lay dozens of miles of small diameter distribution mains through winding suburban streets. You have to negotiate thousands of individual easements. You have to purchase, install, and maintain 18,000 distinct meters. You have to process 18,000 monthly bills and staff a call center to handle the inevitable customer service complaints.
Yeah, that sounds like a nightmare compared to the alternative. To serve those 12 industrial customers,
You dig 12 trenches. You lay 12 high-capacity steel lines directly to the facilities. You install 12 massive industrial meters, and you capture the exact same volume of gas sales with a fraction of the maintenance footprint. The profit margins on industrial baseload are just vastly superior.
that insight alone completely reframes the Atmos growth story for me. They aren't just growing wide by chasing suburban sprawl. They're growing deep by anchoring these massive industrial consumers.
It creates a foundational stability to their revenue that offsets the volatility of residential weather patterns.
Okay, let's shift gears to the second major profit driver discussed on the call, which involves their pipeline division, APT. You mentioned them earlier. Forsyth stated that APT's through-system revenues increased by $34 million, or 16 cents per share.
Right.
He attributed this windfall to, quote, significantly higher spreads. This is where the Wall Street jargon usually loses the retail investor. I want to spend some time translating this. What exactly is a pipeline spread, and how does Atmos exploit it?
To conceptualize a pipeline spread, you have to look at a map of Texas and understand the physical geography of the natural gas market. The vast majority of the natural gas is produced in the western part of the state, in the Permian Basin.
Okay, West Texas.
However, the overwhelming demand for that gas, the sprawling metropolises, the industrial hubs, and the liquid natural gas export terminals, those are located hundreds of miles away in East Texas and along the Gulf Coast.
So we have a massive supply source isolated from the primary demand centers. The molecules have to physically travel across the state.
And Atmos Pipeline Texas owns the circulatory system, the massive interstate pipes that move those molecules. Now, unlike a stock where the price of a share is identical whether you buy it in New York or Los Angeles, natural gas is a localized physical commodity.
Right, because it physically takes up space.
Exactly. Its price changes based on exactly where it is sitting at any given moment. The price of gas sitting at the production site in West Texas, which traders call the Waha hub, can be wildly different from the price of that exact same gas sitting at a destination hub near Houston.
And the mathematical difference between the price in West Texas and the price in Houston is the spread.
Yes. And during the first 9 months of fiscal 26, that geographic price difference blew out to historic proportions. Forsyth noted that the spreads they captured averaged $4.66.
Wow.
To give that some crucial context, during the same period the prior year, the spread was only $1.77.
That is a colossal jump. The price differential nearly tripled. So what broke in the market to cause gas in West Texas to be priced so drastically lower than gas on the Gulf Coast?
It was a perfect storm of relentless supply colliding with a severe infrastructure bottleneck. The first factor is a phenomenon known as associated gas production.
Explain associated gas. How is it different from regular natural gas?
When drilling companies in the Permian Basin sink a well, their primary target is usually crude oil because oil is highly lucrative. But nature doesn't separate the hydrocarbons neatly.
Right, they're mixed together.
Exactly. When they pump the oil to the surface, massive amounts of natural gas come up with it as a byproduct. It is, quote, associated with the oil extraction. Because global oil prices were strong, drilling activity was frantic, meaning a flood of associated natural gas was being dumped onto the West Texas market, whether the producers wanted it or not.
Okay, so you have a localized glut of supply. But if demand is so high in East Texas, why didn't they just ship it out?
Because of the second factor. Constrained takeaway capacity. There simply were not enough physical pipelines in existence to move this tsunami of gas out of the Permian Basin.
I like to think of this like trying to empty an Olympic swimming pool through a single garden hose. It doesn't matter how much water is in the pool, the flow rate is entirely dictated by the diameter of the hose.
That's a very apt analogy. When you have a massive continuous supply of gas coming out of the ground and nowhere to physically put it, the local market price collapses. At certain points over the last year, the price of gas at the Waha hub actually went negative.
Wait, negative pricing? Meaning the oil producers were literally paying people to take the natural gas away.
Yes. If a producer can't get rid of the associated gas, environmental regulations often force them to shut down the well entirely. They would rather pay a penalty to dispose of the cheap gas than be forced to stop pumping the highly profitable crude oil.
That is wild. So gas in West Texas is effectively worthless, practically free, while gas on the Gulf Coast is still commanding a normal, healthy market premium.
Now, put yourself in the shoes of Atmos Energy. You own the physical garden hose connecting the overflowing pool to the desert. You are in the most advantageous position imaginable. You are acquiring incredibly cheap, sometimes negatively priced gas at the Waha hub, moving it through your proprietary steel pipes, and capturing that massive $4.66 differential when it reaches the East Texas market.
It is the purest form of physical arbitrage. A day trader tries to capture arbitrage by clicking buttons and exploiting tiny price inefficiencies on a screen. Atmos captures arbitrage by pushing physical molecules through 36-inch high-pressure pipes, buying low and selling high on a grand scale. They essentially minted money during this bottleneck.
They capitalized beautifully on a structural market inefficiency, yes.
Okay, let's take a breath and summarize the narrative so far, because on paper, this looks like a flawless, bulletproof year.
It really does.
We have a $1.2 billion net income. We have 14.5% EPS growth, driven by a structural regulatory step-up from House Bill 4384. They are adding 51,000 new customers to support the Texas population boom. They're securing massive industrial baseloads and pushing through hundreds of millions in rate increases.
Right.
And on top of all that, they're capturing these huge pipeline spreads. If I'm reading this, I'm thinking Atmos is an unstoppable juggernaut.
It is a phenomenal 9-month performance. But this brings us to a critical transition point in our deep dive. And it's the exact moment where a retail investor needs to put their analytical hat on and really read between the lines.
You're talking about the management guidance section.
I am. The stock market is a forward pricing mechanism. Past performance is a nice story, but investors buy equity for future cash flows. And when you look at management's guidance for the remainder of 2026, they sent a highly contradictory signal to the market.
It was the very first thing that jumped out at me in the data drop. Despite having this absolute blowout performance across the board for the first 3 quarters, Management refused to raise their earnings guidance for the full year. They simply reaffirmed their previous EPS guidance range of $8.40 to $8.50.
By maintaining that flat annual guidance after such a strong year-to-date beat, they are implicitly signaling that the final quarter of the year is going to be exceptionally soft compared to the run rate they've been enjoying.
And it gets more concerning. While holding revenue expectations flat, they actually raised their cost guidance. They bumped their forecast for operations and maintenance spending, known as O&M, up to a range of $875 million to $885 million.
So you have a scenario where the top-line momentum is stalling, but the operational expenses are accelerating.
If I am an institutional investor dialing into this call, the alarm bells are ringing. My immediate question is, why is management playing it so incredibly safe? If they are crushing it this hard, why not raise the year-end forecast? Are they sandbagging or are they hiding a massive headwind? What is the catch?
The catch was revealed quite reluctantly during the Q&A segment of the call. Management didn't proactively highlight the headwind in their prepared remarks, but several analysts zeroed in on this discrepancy and basically forced them to address it.
Let's dig into that exchange. Who asked the tough question and what did management admit?
The turning point came during an exchange with Konstantin Lednev from Wells Fargo Securities. He specifically targeted those highly profitable APT pipeline spreads. He asked if Atmos anticipated hitting the top end of their guidance given the strong year-to-date performance. And critically, he asked for color on the trajectory of those pipeline contributions given recent shifts in Waha hub pricing.
So he knew the physical arbitrage was closing. How did CFO Chris Forsythe handle that?
Forsythe had to concede the reality of the physical market. He admitted that the easy money from those massive spreads was already drying up. He stated clearly that beginning in the latter half of the third quarter, specifically late June and into July, the spreads they were capturing narrowed significantly.
Why did they narrow? Did the Permian drillers suddenly stop producing associated gas?
No, production levels in West Texas remained elevated. What changed was the infrastructure bottleneck. Going back to your garden hose analogy, the pool didn't stop filling up, but a couple of rival pipeline companies just backed up massive fire hoses to the edge of the pool and turned on the pumps.
Competitor takeaway capacity came online.
Exactly. Forsythe explained that additional pipeline capacity from competitors was completed and brought into service. And crucially, some of this capacity came online faster than the market had modeled.
So rival companies finally finished building their own multi-billion-dollar pipes out of the Permian Basin to the Gulf Coast.
Right. He noted that while a couple of these major pipes were slated for the fourth quarter of the calendar year, they actually commenced operations early, one in late June and another in late July. As these new competitor pipelines ramped up, they began aggressively draining that excess trapped gas out of the West Texas market.
And basic economics dictates that when you relieve the supply glut, the local price of gas at the Waha hub rebounds. It goes from negative pricing back to a normal baseline, and that massive $4.66 price differential completely collapses.
The arbitrage window slammed shut. Later in the Q&A, Richard Sunderland, with Truist Securities, pressed them on what this meant for the second half of the year. He asked if an 8 to 12 cent uptick was still the correct assumption for the balance of the year. Forsythe conceded that due to the tightening of the spreads, they would likely land at the lower end of that range.
This is a textbook lesson in commodity market cycles. High prices, or in this case, high price differentials, they cure themselves by incentivizing capital investment. The huge spreads enticed companies to build new pipes, and once the pipes were built, the spreads vanished. Management is holding guidance flat because they know the golden goose has stopped laying eggs.
It was a temporary market dislocation, and the physical market corrected itself.
That explains the flat revenue expectations. But what about the rising costs? Why did they increase the operations and maintenance guidance to that $875 million range? What exactly are they spending that extra money on?
Analyst Richard Sunderland also probed this issue, asking if they were simply pulling forward planned expenses from 2027 into 2026 to mask earnings. Forsythe denied that, explaining the increase is driven by fundamental, unavoidable utility maintenance. He pointed specifically to ongoing compliance, safety-related spending across the Metroplex, and a massive spike in line locating activities to support the regional growth.
Let's focus on line locating for a minute, because it perfectly illustrates the hidden friction costs of regional growth. For you listening who might be unfamiliar with utility operations, what is a line locate?
Underground infrastructure is invisible. Every time a construction crew breaks ground, whether it's a developer building a subdivision, a municipality widening a highway, or a homeowner installing a swimming pool, someone has to physically verify where the buried gas lines are to prevent a catastrophic strike by an excavator.
This is the classic call 811 before you dig protocol.
Yes. By law, when that call comes in, the utility must dispatch a technician with specialized equipment and a can of spray paint to mark the exact location of the pipes in the ground.
And when you are operating in Texas, a state experiencing a historic macroeconomic boom with Fortune 500 relocations and 51,000 new customers, you don't just get a few of these calls. The volume must be astronomical. Everyone is digging, every road is being widened, every neighborhood is laying fiber optic cable.
The sheer volume of locate requests spikes exponentially, and that process cannot be automated. It requires a fleet of trucks, thousands of man-hours, fuel, and dispatch logistics. It is a massive drag on O&M budgets.
That is a fascinating dynamic. The very economic boom that is driving their customer growth is simultaneously generating intense friction costs that erode their margins. But I also see in the data drop that O&M is just a fraction of their total spending. They are deploying immense amounts of capital elsewhere. The transcript notes capital expenditures, or CapEx, of $3.1 billion already deployed this year, and they are on track to spend $4.2 billion for the full fiscal year 2026.
That distinction is critical for investors. O&M represents the day-to-day operating friction salaries, truck maintenance, paint for line locates. CapEx represents money invested in hard physical infrastructure assets that will remain in service for half a century and get rolled into the rate base to generate returns.
But $4.2 billion in a single 12-month period is a colossal amount of capital to deploy. Where exactly are they putting all that steel in the ground?
CEO Kevin Akers provided a breakdown. He stated that over 87% of these investments are purely defensive, focused on enhancing the safety and reliability of their existing distribution, transmission, and underground storage networks. However, they also detailed several massive structural growth projects currently underway in the APT division, specifically designed to support the sprawling Dallas-Fort Worth Metroplex.
I love diving into the engineering specifics of these projects because it grounds the financial numbers in physical reality. You can't fake a pipeline on a balance sheet, you actually have to build it. What are these projects?
They highlighted a multi-pronged approach to fortifying the DFW region. First, they are executing two separate projects southeast of the Metroplex, installing a combined 29 miles of 36-inch pipeline.
I need to pause on that spec. A 36-inch pipe that is 3 feet in diameter. You could literally crawl through that. We aren't talking about the little plastic line running to your barbecue grill. This is backbone infrastructure operating at incredibly high pressure.
The engineering required to safely trench, weld, bury, and test 29 miles of 36-inch high-pressure steel pipe through populated areas is staggering. These specific lines will connect 2 adjacent compressor stations to their Tri-City storage facility.
What is the strategic value of that connection?
It creates redundancy and flow capacity. It enhances their ability to pull gas from the Haynesville and Cotton Valley shale production areas and inject it directly into storage, ensuring that the DFW Metroplex has a massive, reliable reserve of gas immediately available during extreme winter weather events, mitigating the exact kind of supply shocks that caused Winter Storm Uri.
Fortifying the grid against the next freeze. They also mentioned a major project east of the Metroplex in Carthage, Texas.
Yes, Akers noted they began construction on a bilateral compressor station in Carthage. The goal of this station is to drastically increase the throughput capacity of their existing 36-inch line S2 pipeline.
For those who aren't petroleum engineers, a compressor station essentially acts as a massive industrial pump. As gas travels over long distances, friction causes it to lose pressure. A compressor station squeezes the gas, increasing the pressure and pushing it further down the line, which effectively increases the total volume of molecules you can shove through a pipe of a fixed diameter.
It maximizes the efficiency of the existing asset. Finally, they highlighted the culmination of a massive, multi-year endeavor known as the WA Loop Project. They're completing the final phase to support explosive demographic growth in the northwestern portion of the Metroplex. This last leg involves installing another 15 miles of 36-inch pipe, which will close out a staggering 92-mile pipeline loop around the region.
A 92-mile continuous loop of 3-foot-wide steel buried in the Texas dirt. When you list out the sheer physical scale of these projects, the compressor stations, the 92-mile loops, the storage injections, that $4.2 billion capex figure suddenly makes complete sense. And Akers noted that all these major projects are scheduled to be placed into active service by the end of this calendar year.
Which is the catalyst for the utility investor. Once those assets are placed into service, they transition from being a capital drain to a revenue generator. They are submitted in the next rate case, and Atmos begins earning their regulated rate of return on those billions of dollars.
Okay, so we've established they are undertaking biblical amounts of construction. But in the current macroeconomic environment, with interest rates elevated and the cost of capital squeezing corporations globally, my immediate concern turns to leverage. If a company is spending $4.2 billion in cash in a single year, how are they financing it? Are they drowning in debt to build these pipes?
This is perhaps the strongest part of the entire earnings transcript, and it's where Atmos proves its defensive pedigree. Their balance sheet is structured like a fortress. Forsyth reported that their equity capitalization ratio ended the quarter at 60%.
Let's emphasize that. 60% of their total capital structure is pure equity, not debt. In an era where many infrastructure companies run heavily leveraged models, maintaining a 60% equity cushion is exceptionally conservative.
It insulates them from credit market shocks. Furthermore, Forsyth made a point to highlight that Atmos currently has zero short-term debt outstanding. None.
Zero short-term debt. That means they have absolutely no exposure to sudden spikes in short-term interest rates. They aren't caught in a cycle of having to roll over expensive commercial paper every 90 days just to make payroll.
They are structurally immune to short-term liquidity crunches. And speaking of liquidity, at the end of the quarter, they boasted $4.6 billion in available liquidity to support their operations.
$4.6 billion in dry powder. That is an enormous safety net. Does that include cash on hand and revolving credit facilities?
It does, but crucially, it also includes approximately $937 million in net proceeds available under existing forward sale agreements.
Let's translate that Wall Street mechanism. What exactly is a forward sale agreement, and why does a utility use it?
A forward sale is a highly strategic financial tool. It is an agreement where Atmos commits to issue new shares of stock to an underwriter at a predetermined locked-in price today. However, they don't actually issue the shares or take the cash immediately. They hold the agreement in their back pocket, and they can draw down that cash whenever they physically need it to pay construction bills in the future.
It's brilliant. They get to lock in their cost of equity capital right now, based on today's stock price, to fund a pipeline they might not finish building for another 8 months. It completely removes the risk of a sudden market crash destroying their ability to fund their capex program.
Exactly.
Yeah.
Forsyth noted that this $937 million in forward agreements is expected to fully satisfy the remainder of their equity needs for fiscal 26 and a significant portion of their anticipated needs for fiscal 27.
So the funding for their aggressive growth is already secured, priced, and waiting in the wings. When you combine a 60% equity capitalization, zero short-term debt, and $4.6 billion in liquidity, you start to see why this stock acts as a metronome for a portfolio. They have essentially bulletproofed themselves against a credit crisis.
The financial engineering is just as impressive as the physical engineering.
All right, we have covered an immense amount of ground in this deep dive. We have analyzed the headline earnings beat and the regulatory mechanics of House Bill 4384. We've explored the physical logistics of adding 51,000 customers, the incredible leverage of industrial baseloads, and the fascinating physical arbitrage of pipeline spreads. We've also dissected the compression of those spreads, the rising friction costs of line locates, the massive capex deployment, and their fortress balance sheet.
That is a lot of data.
It is. But now, we have to deliver on the premise of talk tickers. We need to synthesize all of this data and make it actionable for you listening right now. We need the bull case, the bear case, and the final verdict. Let's start with the bull narrative. If I am an analyst arguing that Atmos Energy is a screaming buy today, what is my strongest structural argument?
The most compelling bull case for Atmos centers on a unique combination of regulatory harmony, hyper-efficiency, and consumer goodwill. On the call, management highlighted a metric known as wallet share, and it is the linchpin of their long-term viability.
Break down this wallet share metric. Why is it so crucial?
During the Q&A, analyst Luke Finker probed management about customer bill affordability in Texas, knowing that inflation has been squeezing the middle class. Management directed him to a specific data point in their investor deck. An Atmos natural gas bill currently makes up only 1% to 1.2% of a median customer's total wallet or household income.
Meaning, out of every $100 a family earns, they are only spending $1 to heat their home, run their oven, and take a hot shower.
Yes. And they contrasted that directly against electric bills, noting that electricity commands 2 to almost 3 times that amount in wallet share. They further pointed out that on a pure energy comparison basis, measuring actual BTU heating power gas bills across their service territories are actually 2% to 4% lower than they were last year. Natural gas is definitively the cheapest utility bill in the house.
From a consumer standpoint, that's great. But why does a Wall Street investor care if the customer's bill is cheap? Shouldn't investors want the company to charge as much as possible?
If Atmos were an unregulated software company, yes. Remember the cycle we discussed earlier. Utilities must constantly ask state regulators for permission to raise rates and recover their capital. A rate case is a highly political event. If a utilities bills are exorbitant, if they are making headlines for crushing low-income families with rate hikes, a public utility commission will face immense political pressure to deny or slash their rate requests.
It's political capital.
Precisely. If Atmos can walk into a regulatory hearing in Austin, open their books, and prove that their vital service only consumes 1% of a family's income, and that bills are actually down year over year, the regulator faces very little political blowback in approving those necessary infrastructure investments. It paves a smooth, frictionless path for regulatory approval.
It guarantees the continuous cycle of capital recovery, and it seems to be generating incredible goodwill with the public. CEO Kevin Akers noted that they achieved customer satisfaction ratings in excess of 97% for the first 9 months of the fiscal year. 97% satisfaction for a utility company is a statistical anomaly. Most people actively despise their utility providers.
It requires proactive management. Akers highlighted their customer advocacy teams, noting they actively assisted nearly 49,000 customers in securing roughly $16.2 million in state and federal funding assistance. They aren't just sending disconnect notices, they are actively helping struggling customers pay the bills.
And their goodwill mechanism extends beyond just advocacy. They discussed a tariff mechanism on the call a few times called Rider Rev. This seems like a massive component of the bull case. What is Rider Rev?
Rider Rev is a specific regulatory tariff tied to the profits of their pipeline division, APT. When APT captures extraordinary profits, like they did by exploiting those massive $4.66 pipeline spreads we discussed earlier, the regulatory framework dictates that they do not get to keep 100% of that windfall for shareholders. They are mandated to share a portion of those excess profits back with the local distribution customers on the system.
Wait, they distribute the arbitrage profits back to the everyday ratepayer?
Yes, in the form of direct revenue credits on the monthly bill. Akers noted that this month, APT is submitting its annual Rider Rev tariff filing, seeking to reflect $160 to $165 million in revenue credits. He proudly stated that, if approved by regulators, Atmos customers will have received over $300 million in direct savings through this mechanism between November 2023 and October 2027.
Okay, let me synthesize this bull case because it is formidable. You have a physical infrastructure asset growing its customer base by the size of a mid-sized city annually, anchored in the most demographically explosive state in the union. They possess a fortress balance sheet with zero short-term debt and massive liquidity. They are hyper-efficient, keeping their product costs down to just 1% of a household's income. And they generate so much excess cash from their pipeline arbitrage that they are actively refunding hundreds of millions of dollars to their customers, practically guaranteeing regulatory harmony and a 97% satisfaction rate. If you are a defensive investor, that narrative is practically flawless.
It is the platonic ideal of a sleep-at-night utility stock.
But this is talk tickers. We do not just cheerlead management teams. We look for the cracks in the foundation. It is time for the bear case. Based on this transcript, why would an investor hesitate to allocate capital to Atmos Energy today?
The bear case is firmly rooted in the realities of valuation, forward growth expectations, and market psychology. The headline number that will grab retail investors, the 14.5% earnings jump, is fundamentally a mirage.
It's the legislative ghost of House Bill 4384?
Yes. That benefit was a one-time structural reset. It is now fully baked into the historical baseline and priced into the stock.
Yeah.
Furthermore, a massive pipeline spreads that supercharge their cash flow in the first half of the year are rapidly compressing as competitor pipes relieve the West Texas bottlenecks. Management outright admitted during the Q&A that the blowout double-digit growth of this year is definitively over.
They telegraphed that they are modeling a return to their historical pedestrian 6 to 8% growth trajectory moving forward.
Which forms the crux of the bear argument. If you buy Atmos stock today, there is a very real risk that you are buying at the absolute peak of a cyclical and regulatory perfect storm. The spreads are gone, O&M friction costs for things like line locating are accelerating, and you are only going to see mid-single-digit growth next year. If the broader market is currently pricing Atmos shares as if it's a high-growth momentum asset based on that 14% headline, you could suffer significant capital depreciation when the market eventually realizes the growth is normalized.
It is the classic trap of buying yesterday's news at a premium valuation. You cannot safely extrapolate the anomalies of Q3 2026 into a 10-year financial model.
The underlying business is phenomenal, but the entry price and growth expectations must be rational.
Okay, we have the raw numbers, the physical mechanics behind the numbers, management's highly cautious forward guidance, and we have laid out the bull and the bear arguments. Now it is time for the bottom line. It's time for the verdict.
Where do you land on the actionable rating?
I am taking a definitive, opinionated stance on this. If you are an aggressive retail investor looking for the next NVIDIA, if you want triple-digit, high-growth tech returns to double your portfolio in 18 months, turn around and walk away from the sector entirely. Atmos Energy is not going to double your money next year. The math simply does not support it. But based on the deep operational realities we've unpacked today, I view Atmos Energy as a solid hold for current investors who are already enjoying the yield, and a very strong defensive buy if you are looking to park capital in a safe harbor during macroeconomic uncertainty.
I agree with that assessment. The balance sheet metrics alone justify a defensive allocation.
You are looking at a management team that is deploying $4.2 billion to modernize and expand a critical physical network, with 87% of that capital targeted directly at safety and reliability. They are sitting on $4.6 billion in liquidity with zero short-term debt. They are geographically anchored in the epicenter of the American corporate migration, riding a demographic wave of Fortune 500 relocations. Yes, the 14% growth was a regulatory anomaly, and yes, management is sandbagging the guidance because the pipeline spreads have collapsed. But honestly, that is exactly what you want from a utility management team: conservative, highly realistic, unsentimental forecasting. If you want an equity position that lets you sleep soundly through a recession while cashing reliable dividends backed by the sheer physical reality of a Texas population boom, Atmos is a premier play. Just approach it with your eyes wide open. Do not expect another 14% pop. Accept the 6 to 8% grind, appreciate the fortress balance sheet, and enjoy the stability.
That perfectly encapsulates the utility investing thesis.
Yeah.
You are not buying disruption. You are buying the infrastructure, the regulatory relationships, and the structural integrity of the balance sheet. Atmos appears to be executing flawlessly on all three of those fronts.
So we've covered the microeconomics of the company, but before we wrap up, I want to leave you, the listener, with a broader macroeconomic puzzle to chew on. Something that builds on what we've discussed today, but pushes it a step further into the future of American energy. We spent a lot of time analyzing that wallet share metric. Management made a very compelling point that natural gas takes up roughly 1% of a median customer's wallet, massively undercutting electric bills, which they noted are 2 to 3 times higher.
It is a profound structural cost advantage for the consumer.
Now, zoom out from Texas and look at the national energy landscape. The electrical grid in this country is currently buckling under unprecedented, rapidly accelerating new loads. We have federal and state mandates pushing a massive transition to electric vehicles, which require immense amounts of charging power. Simultaneously, we have the explosion of artificial intelligence, which requires hyperscale data centers that consume gigawatts of electricity around the clock. As the aging grid strains under the sheer weight of EVs and AI, billions upon billions of dollars are going to be required to upgrade transmission lines, build new substations, and deploy new generation capacity.
And as we've established today regarding utility rate cases, those enormous capital costs are eventually, inevitably, passed down to the ratepayer in the form of higher monthly bills.
Exactly. Given the sheer scale of the required grid expansion, electric rates are almost mathematically guaranteed to push ever higher over the next decade. So here is the provocative thought for you to consider before you execute your next utility sector trade. As electricity becomes increasingly expensive and the physical grid becomes more fragile and prone to blackouts under the weight of this new tech-driven demand, does the old school natural gas hook up the physical pipe that currently only costs 1% of your wallet and works even when the power lines fall down, suddenly become the ultimate inflation-resistant energy play for the American consumer? If millions of homeowners realize it is simply becoming too expensive to heat their homes with a straining electric grid, does the demand for physical natural gas infrastructure experience a long-term renaissance that Wall Street is currently failing to price in?
It is a fascinating thesis, and one that directly challenges the prevailing cultural narrative that every aspect of our lives must inevitably and immediately be electrified. If cost and reliability still matter to consumers, and history suggests they always do, the physical reality of natural gas has a highly compelling multi-decade argument.
Think about that inherent tension between the electrified future and the physical economic reality of natural gas the next time you evaluate your portfolio allocations. Thank you for joining us on this deep dive into Atmos Energy. Keep questioning the headlines, keep demanding the translation of Wall Street jargon, and keep crunching those numbers. We will catch you next time.